Yeah. So.
Right, firstly, a great turnout tonight. Thank you very much for all coming. My name is Tanya Simpson and this is Wayne. Obviously Wayne is from our Dunedin branch and I'm from the Mosgiel branch. So good evening everybody. Tonight, just a few house rules, obviously with toilet facilities through the two main doors here and then you'll turn left. Also, if there is a fire emergency through the exits, we'll follow Courtney. Not now, but if there is an emergency. Again, tonight, our major sponsors for this evening are the Loan Market, which is Sally, Gary and Ben. We want to thank you very, very much for this evening. We couldn't have done it without you guys, so we really do appreciate it. And another major sponsor for this evening is Blue Skin Electrical, and that is Annie and Rich. Where's Annie and Rich? Thank you very much, guys. We really do appreciate it. Now, I'm just going to hand you over to Wayne for the next part.
Just do that drawer for Loan Market.
Oh, we've actually got a drawer from Loan Market. We've got 4 spot prizes underneath your seats. If you all can stand up and look under your seats now, and let us know if you've got a winner on them.
Yeah. Have a look, Gary.
So let us know, those who have got the prizes, can you please come up?
There might be one in that second row there that no one's found. I can't quite remember where. To be the closest people.
Courtney, where did you put them? Has anybody got any, or we're going to have to just hand them out? Nobody's won, nothing.
They're on the front, underneath the bar.
Anybody? Courtney, did you put them under the seats?
Oh, was I supposed to do that?
Did you not?
Oh, I did.
Oh, Colin. Come on up, Colin.
Colin just said he never wins anything.
Did you say that? That's one. Congratulations,
Thank
Colin.
you very much. You're welcome.
It's the first thing you've ever won, Colin.
So, guys, we've actually got
Another
3
one.
more to go.
Another one.
Oh, congratulations. Thank you very much. 2 more to go. There's all these chairs. Oh. Fantastic. Thank you. 1 more. Have you guys looked at these seats over here? They're empty. Is anybody going to go for it, or am I going to get Courtney to win it herself? Come on. Quickly. Don't be shy. Come on. These 2 chairs here. Have you looked at those 2 chairs?
We got one left over.
There surely has to be another one out there.
If they find it during the night, let us know.
Okay, Ted, if you can find it throughout the night, just let us know and bring it up to us, and you can claim the prize. Oh,
we got
Karen,
it. We got it.
Thank you very much. Thanks, Karen.
Thank you.
Congratulations. That's sponsored by Loan Market. Thank you very much, Karen. Sally and Ben. Okay, here you go.
Thank you. We're just going to kick off. We have 3 speakers tonight, or 3 lots of speakers. We're going to start off with Judd Delarouche. So he's one of the top real estate agents in Dunedin. And he's going to be followed by the Loan Market, which are brokers, mortgage brokers, and we've got Sally, Gary and Ben, but Sally doesn't want to talk, so Gary and Ben will get up.
Sally's a bit shy.
And then our third speaker tonight is David Faulkner, who is our General Manager of Property Management in New Zealand, and he's come down from Palmerston North to have a bit of of a talk about the future of renting in New Zealand. So Judd, if we can start with you, please. Thank you.
Thanks very much, Wayne. Hey, congratulations on coming out on your evening and taking a little bit of time. I remember many years ago there was a trainer who said to me that the television is the electronic income reducer. And, you know, like, we don't read enough books, we don't listen to podcasts, and we don't go out to seminars at property brokers every day, do we? So, hey, congratulations, because, like, you know, you don't have to be a rocket scientist to work out that, you know, as we approach retirement, there's probably three odd things that are going to happen. They're either going to means test us, or it's not even going to be there at all. What are they going to do with it? You know, it just may accompany with third fingers. But, you know, it's really important that we get together and try and make some money, basically, and that's what we're here to talk about tonight. Who has invested in property, or who wants to start buying something? Shall I? Yeah, lady at the back there, very good. Look at the next slide there, please. So, actually, go back a week, back one. Thanks, Courts. This one's interesting. Okay, so go to the next one. That'd be great. Thanks, Courts. So I think, like, when you look at the title, which was the future of renting, I thought, well, that's an interesting title, really. It takes a tenant and it takes a landlord to have a future, doesn't it? And I thought, let's peel it back to some of the interesting stats as to what may create a situation where more rental properties are required. And if you look at this graph over here, that one there is, it's interesting that that is house ownership, and that has slipped hugely since 1988, and it's gone right down to 64%. So it was, you probably can't see that, it's like 74. Yeah, that's good, thank you. So that's whittling away a little bit, and to be fair, like, probably when those stats there come out, oh, there we go. So when those stats there come out a little bit more, I don't think it's going to be 64.6, it's going to be a little bit lower again. And the other factor involved with how many rental properties we're going to need is obviously the population. The population seemed to stay at like 3 million people for years, didn't it? It was always 3 million, next thing it's 5. And it's just going up and up and up. So we've got more people, we've got less home ownership, you know, to the point that, you know, if you walk past 10 people in the street, 4 of them are going to be renting. So it's quite significant. And also, if we look at affordability, which is the next graph, Courts, that's really interesting too. So this is the average house price as a percent of the average annual income. And interesting how high it was back in the 1920s. Quite interesting. But it dropped there for a wee while, but we seem to be on quite a rise going on there as time goes on. So it's not surprising that we have less home ownership going on in New Zealand at the moment. So there's certainly a very, very good future for renting, that's for sure. Do you know how long it took me to make that clock jump up when you go turn around? Who has ever seen the real estate clock before? That's the good thing about the situation that we're in at the moment. It's not the first time it's happened, and it'll happen again and again and again. And it's probably I would say the best place to start is probably around about 9 o'clock. And 9 o'clock probably was 2015. So that's when the market really started to lift. And I've got a really interesting graph to show you in a wee minute with that. Sorry, it's a night of graphs, so I hope you like graphs. But like, I was going to say earlier, like the Real Estate Institute, I've been selling real estate since 95. And in 92, they started recording real estate transactions around New Zealand. I think probably it was a matter of computers becoming a little bit more mainstream, and they could track all of that. And so we have like 30 years of incredible data, and Ryan's Real Estate Institute, New Zealand, they sell that to the trading banks, and they sell it to the Reserve Bank of New Zealand, and it's probably a really big source of income for them. But you've got to hope that the Reserve Bank of New Zealand use that information quite wisely. And historically, they're very good at looking in the rear vision mirror and applying something that probably shouldn't be applied at this particular moment. So it's very important, those stats. But if you look at 9 o'clock, and if you imagine that that's 2015, the prices were starting to rise, and therefore the number of sales was starting to rise. And that's simply because humans see that their house is going up in value and they think, well, crikey, I'm going to capitalise on this and I'm going to trade, or I'm going to move. So that gives people great optimism. And you get rising construction as you go like 10 o'clock, 11 o'clock, and then things peak right at the top there at 12. And then there is an oversupply all of a sudden because the market stops buying. And we go around to 3 and we've got falling sales, we've got volumes which start to get a bit interesting as well, and falling construction down around 4 o'clock, 5 o'clock, and then the prices bottom out at 6. Where do you think we might be? Any thoughts? Did someone say 6? 4? Any other takers? Yeah. I tend to agree. I think we're somewhere here, 4 and 5. We don't quite know where the bottom is. If we did, that would be very useful. But we don't. Can you go to the next one, please, Courts? So the real estate clock also mimics this, which is all about investment properties, yields, and rental returns. And remember the yield for a rental property, which is basically like its return and its cap rate. It's sort of the same thing, different names. It's like GV, CV, government valuations, lots of different names for that too. But the yield is simply the income over the asset value. So your income over the top, when you're working that out, is 52 weeks of your weekly rent. It's your gross income, and then your asset value is underneath that, and that's how they work out yield. And if you start again over here, and that again was really 2015. Money and credit was really, really easy to get. And people went out and bought houses. Also tenants would have felt quite flush at that time. The economy is doing very, very well. And they were quite happy to probably pay a larger rent. And the value of property goes really high and maxes out at the top of the market at 12 o'clock. And then after that, the property values tend to weaken because there's less people chasing it. The yields drop, and you've still got high rents. The yields rise at 2 o'clock, and then you've got sales activity falling around about 3. Property values continue to decrease at that point as well. You've got less money in the economy at 4, and rents fall. And David's going to talk a little bit about rents falling. It's kind of an interesting thing. There's so much going on in our economy at the moment. There's so many levers that are being pulled. So not everything definitely happens according to the clock. So rents stabilise, and rents stabilise because what the tenant theoretically wants to pay and what the tenant will charge come into equilibrium. And that, of course, is the place to buy right at the bottom at 6 o'clock. Does that make sense? Next one, of course, would be great. So this is a really interesting graph, and this is all courtesy of Ryan's. The faint bit at the back, that's New Zealand as a whole, and Dunedin is the darker one at the front. And as you can see, they mimic each other perfectly. There's lots of fascinating things in this. Does anyone work out what that would be?
Lockdown.
Yeah, lockdown. So lockdown caused a few issues. There were actually some sales that happened in lockdown because agents adapted quite quickly to that and did things electronically for a wee while, but the number of sales was down, and therefore the average price was down as well. So that was a very interesting aberration. That's when they started collecting data in '92, and Dunedin's prices stayed at at 100, it was actually about 105 that it averaged it all that time. Like, it's a long time to stay the same. And like, there's many a person who bought investment property during this time, saw nothing happen, and resold it. And I had a father-in-law at the time who bought a house in Montrose Street, actually, bought 2 of them. And he bought it for 90,000, waited 5 years, got sick of this, sold them again for essentially the same money. I did take a commission off him though, so that was right. Yeah, he had a good sense of humour. But at this point here, like 2003, it's about the autumn of 2003, the market really took off. And it was because it was immigration really, and there was an immense amount of UK residents came and South Africans. And I remember thinking, you know, like every open home, there was like a token South African and a token English person like in the room. It was amazing. They must have really opened the floodgates. And with that, they brought a lot of money. It's very interesting because they changed the perception of distance as well. Like, people used to think going to Mosgiel was hard enough, like going out to Outram or to Allenton was like, you know, a camel trek. It was like just so far. And those 2 demographics, like, they didn't worry about that. It's very interesting how they changed people's thinking. But the average price went from 105 and it went up to about 250. So it's 250% increase. And that happened in just a couple of years, took about 3 years. And then we got to 2007, what happened there? GFC, World Financial Crisis, global financial crisis. And that made the whole thing level off at around about 250, 260,000, right through to 2015, where it took off again. And so it's really interesting. So you can see these cycles going on here. And what was the reason for things taking off here again? Interesting question. I think the economy was doing very well at that time. We did have high immigration again. Immigration is like a massive key to increase the prices of houses, obviously. And then it's continued for a long time. I mean, we've had 7 years of growth, which has been extraordinary. But you'll see, I'll go back with it, that it probably should have, around about here somewhere, it probably should have started to level out. That would have been the natural thing. But what came along and around about there? COVID came along. And so the government decided that they needed to stimulate the economy, and they printed a vast amount of money. And they gave it to everybody, and the banks gave it out like confetti, and it continued that increase. That's my theory. I don't think I'm a million miles away. But we got to a point just before Christmas where it became a real political football, really, didn't it? Because there were young people who couldn't afford houses, and that's not a great political thing. And so they decided that they would try and halt things. Probably next slide, actually, would be great. This one here is probably a little stylised version of Dunedin on its own. And these here are sales volumes over the years. And you can see how, after all those years of nothing happening, how the public was so excited by price increases. And they decided they'd sell when they would trade and do something, because they had more equity in their properties, and the market went ballistic. You know, we think the last 5 or 7 years has been busy. That was unbelievable. Like, you would be at open homes, and there would be people would have a quick look around the house, and there'd be 2 or 3 who would wait while you were packing up because you had to go to another open home. They wanted to put an offer in there and then. And it was really interesting times. So I think we got up to like a high of something like about 250 odd homes for the month. So they're monthly sales over there. And at the moment, like, it's been relatively, I mean, it doesn't look particularly constant, does it? But the average there is around about 150 houses every month that we're selling in Dunedin. And again, that's lockdowns, that little strange blip right there. If you go to the next one, Cords. So if we look at that little spot on the graph, do you know how long it took me to get that little thing to come and do that? So probably the next one, Cords, thank you. So this is a stretched out version of that up and down. So if you look at that, like that's about 21 months. So at the moment, we're back to what the price was 21 months ago. So it was 600,000 as an average price back then, and it's back there again. So it's gone up and it's gone down. Got the next one, Cords. So currently, like the median price in Dunedin for August is sitting at 600. And the median GV is 430. So I think everybody has their own little ways of working out what they should pay for something, and so there's lots of different formulas, but like it's always quite interesting to know. So it's 140% of your GV equals your price at the moment. But we know that GVs are for rating purposes, but sometimes a good indicator, isn't it, when you don't really know. Prices have doubled in the last 7 years. It's a good party statistic. The next barbecue over the weekend, you can tell people that. Did I just press that? Yeah. And the number of sales in August was 153, so that's that 150 sort of area coming up again. And the days to sell was like 47. So like right through that whole last 7 odd years, the average time to sell sat between like 20 days and 30 days. And that takes into account auctions, and it takes into account tenders and deadline sales, which immediately puts 3 weeks on it. So if you had a system of selling by negotiation, then often it was disappointing if you didn't have an offer on a property after the first open home. That's how unbelievable it was. So it was pretty interesting and dynamic times, but that has gone out 47 days now. So you know, the vendors are spending a little bit more money. They're probably a little bit more anxious about selling. It's just taking a little bit longer. So what happened? The COVID thing, the government has printed a huge amount of money, and seemingly, on my research, like all civilizations through time who have issued money that doesn't have a gold standard, there is a price to pay. And like there's been lots of economists who have said, oh, it's okay, it's just printed money, it's all within our economy. But the problem is it's caused like a lot of inflation, because you've got a whole lot of money chasing a whole lot less goods. And look, there's a lot less goods for a number of reasons. You've got supply chain issues as well. You've got a war going on, and that's affecting things like fertiliser. Are there any farmers in the room? The fertiliser's actually gone up hugely. And so, like, to the talk that some people won't be putting fertiliser on next year, hoping that it'll come down in time. And there's green energy issues as well. So that's causing some increase in costs along the way as well. So it's not surprising that we've had lots of inflation. So what did they do about that? Probably the next slide, thoughts. They pulled some political levers to really slow that inflation down. And I've got a picture of a canary there because like the rest of the world actually is looking at us because we are the canary in the coal mine. We've pulled levers to halt the situation that we're in like no other country's done. And so they're trying to work out whether the canary dies before we can get the situation back under control. So they're trying to get inflation right back under control. You got the next slide, Courts. So what they did, just before Christmas, they introduced the CCCFA. Who knows what that stands for? I have to think every time. It's the Customer Credit Contracts Financial Act. Can't make that stuff up, can you? And that came in just before Christmas. When we came back after Christmas, it was like somebody turned the lights off. It was unbelievable. Prior to Christmas, we were probably having a good 20 people to a good open home, quite religiously, and then after Christmas it was probably down to 5. We lost multiple offers, they were a lot harder to get, and we lost a lot of cash buys as well. So all the contracts, say all of them, but a lot of them became conditional also. So it was a massive change, and that is why the graph has gone down the other side. It's due entirely to that. So it's very interesting. So the Reserve Bank, they also control monetary policy with the official cash rate. So if they put that up, the banks follow it and put their interest rates up as well. They're saying that the interest rates, and Gary will be able to talk a little bit more about that, and Ben, but they're sort of talking of a few more increases, so it'll be interesting to see what you say about that. But I think the economy is contracting actually quite fast, and it'll be very interesting to see whether they really do see through their set of increases which they're saying is going to happen. Interest rates are really interesting. This one over here, that is New Zealand interest rates in the blue, and that is that's Australia in the black. You can see why we're controlled by Australian banks, can't you? But the thing is if you look at that last little bit where it's increasing there, it looks terrible when you look at a graph like that. But relative to the fairly recent past, it's not really the end of the world. But the end of the world comes if that keeps going up, and so you can see why they've put the brakes on as fast as they possibly can. So the good news for investors. I'm trying to give you some good news. Okay, so the equity in your property has increased hugely over the last few years, and you'll be well aware of that. It's interesting in society at the moment because you've got the first home buyers which have bought a house in the last couple of years, and they've put their 20%, 30%, whatever they need into that, and that's at risk, isn't it? That's the scary thing. And like the rest of society that owned a house, their equities increased, as you saw before. It's doubled in 7 years. It's gone up about 28% in the last 3 years. So someone who owned a properties or properties is in a pretty good state. The amount that you can borrow against this equity has increased. The affordability of investment property is getting much better as the price is correct. Buying in a lower mark is a good strategy, as of course it's going to go up one day. You've got to remember the real estate clock just turns around. Tenant demand in Dunedin will increase with the hospital build and other major projects that are going on. There's billions being spent in Dunedin, and we're a small town, so that's going to make a huge difference. And supply of houses will increase as the summer approaches as well. And an adjusting economy means opportunities to purchase where others are too fearful. Because when things are tough, the news is always bad, the ODT doesn't have great news and everyone gets depressed. So you've got to be the brave person, don't you, to go out there and approach the loan market and say, how much can I borrow, and go and buy something. They say that you shouldn't follow the herd, you should go the opposite way. So you should be counter-cyclical, but you've got to be very brave to do that. I thought I'd give you some investor hacks. So if you're looking to purchase something, this might be something that you might want to consider. And I think it's really important not to look like or feel like you're the person taking advantage of somebody's difficult situation, because at the end of the day, that person needs someone to buy their house to get out of that difficult situation. So look for homes which have been on the market for a month plus, and they're likely to be like 5% too expensive, because the market responds extremely quickly. And the interesting thing about this market is it's not that demand is actually reduced, it's been reduced artificially by some of those levers that are being pulled. So there is actually really, really good demand out there. It's about getting the money. I think you'd agree with that. So look at the small ads in the papers. Other buyers tend to disregard them. Us real estate agents put everything up in lights. So we have the big ads. It's right across social media. because we're trying to attract someone in a very, very short time. And if that doesn't work because the property's too expensive, then it will become smaller because the advertising gets smaller. And that also applies to realestate.co and Trade Me and those other websites that advertise property. The properties will end up on page 2, 3, 4 and 5. So there probably are some really good houses there. It's the old story, if it hasn't sold you think something wrong with it, but there's probably nothing wrong with it. It's probably just slightly too dear. It's not too much too dear. It doesn't take too much, it's about 5% to put people off. Seek sellers who are motivated. Perhaps they're moving out of town. It's okay to ask the agents why they're selling. We can't possibly tell you anything that gives you a strategic advantage, interestingly enough. But if the vendor allows us to tell you why they're selling, then we can tell you why they're selling. Buy the house with the purple rooms, the expensive carpet and the overgrown garden. And that's for obvious reasons, because people want things real easy today. So if you buy something which is naturally unappealing on the market, then you will buy it for a discounted price. That's why if you are selling and you do have purple rooms, for goodness sake, paint them. Buy the property that works for you, whether it's new, second-hand, flat, apartment, or a townhouse or a family home. Property with subdivision potential, so it might be something like that as well. But like if you are worried about the lawns at your rental property, then a flat or an apartment is the thing that's going to work for you. If you can't deal with tenants and legalities surrounding this, then it's really important to get them managed. I've met many people over the years who have sold properties because the tenant situation was just too hard for them, and as a result, they've lost hundreds of thousands of dollars. And it's really sad. Like if you get to that point, give property management a go. It's just too valuable to toss it all in. I've always said if you don't buy it, you can't sell it. And that's pretty true, isn't it? You've got to be brave in this market. Always consult your accountant, solicitor regarding bright line and interest deductibility and all those things. Accountants and solicitors know how to charge, but probably not as well as we do. So you should always seek their advice. Got another slide, Courts. This is an interesting thing. I'm sure a lot of you are familiar with cap rates. Cap rates, yields, returns, all again the same thing. And this was just an example. If you went to an open home and the advertised price, it might be negotiable from $399, or it might just be the agent might say, look, somewhere around the $400 we're looking. If the rent on that property, if a rent appraisal was at $480, then the cap rate is 6.24. So the return on that, the gross return on that property is 6.24. Now, if you say to yourself, look, I'm not going, I'll go down to 6% return. That's as low as I'll go. That is the rental return. Then the most that you can pay is 416. So that, I don't know if you remember your maths from 5th and 6th form. You just move that equation around to get the right thing. So you can manipulate it to work out exactly what you should pay to retain a certain cap rate. But you're probably familiar with that. With the next slide, Courts, if you want to actually take a photo of that with your phone, it takes you straight to a cap rate calculator, which is really quite a cool little thing. And you can put in your returns, your purchase price, you can put in a percentage for cost, you can put in a percentage for vacancies, and it'll pop a figure out the bottom as to what your return is. We could put that up a wee bit later if you want to look at that. Okay, hey, this is a real example, just about finished. This was a property that Carol and I actually owned, and we sold it just recently in August, the 12th down there, and we bought it in July, so that was 6 odd years ago. And at the time, we put $40,000 into it, and of course we would have needed a bit more equity than that, but that would have come from equity in other properties. But we put $40,000 cash into it, so it had a $280K debt on it. And in that time, we reduced that debt to about $250, but our equity went to $400, just by going up by the increases naturally over time. So that 40K turned into 400K. And so the power of investment property is just extraordinary, and it's been so good for the last few years for sure, but you've really just got to have it long enough so that you get lucky at the right time. Okay, cool, that's what we got there. So you'll miss 100% of the shots you never take. So Wayne Gretzky was a very good Canadian ice hockey player, and that was his famous quote, and I think it's very, very true. You've got to give it a go, so you've got to get out there. So what I would suggest is that you talk to Gary and Ben and Sally and look at reassessing how much money you've actually got, because it's a really interesting process to do that, isn't it? And just get yourself in a position that if something comes up that is really worth having, you can purchase it. So that's all I've got to say. Thank you.
Thank you very much, Judd. Does anybody have any questions for Judd this evening? No?
Do the panel at the end.
Panel at the end. Okay, no problem. Okay, Gary, Ben and Sally, can we welcome you up here? Well, Sally's just going to stay there for you. Okay, no problems. Thank you very much.
Thank you. Yeah, I'm still a bit tired tonight. Reckons your voice won't hold up, so I'll be put in the hot seat. So just on behalf of Sally, Ben and myself, thanks for the opportunity to come along and give you our thoughts on what's going on out there, mainly around interest rates and the lending landscape. I think Judd touched on a bit of what I'm going to talk about, which is the Triple CFA, or the Credit Contracts and Consumer Finance Act. That was introduced by the Consumer Commerce Minister David Clark on the 1st of December 2021. And it's fair to say that's been the biggest change that we've seen in the lending landscape since the Responsible Lending Act was introduced in 2015. Sally and I have been doing this job since 2004, and it's fair to say that since we've started the Responsible Lending Act, it did put some emphasis on the banks to make sure that there was affordability there for any borrower that they lent money to, but the Triple CFA was an absolute game changer. It placed a far greater emphasis on the banks to actually do a more detailed analysis on clients to ensure they could demonstrate affordability. I know you've probably seen a lot of things in the media about borrowers saying they've been turned down because they've had too many coffees, takeaways and things, but from what we see at the coalface, it is literally like a forensic analysis of someone's bank account history and spending habits over the previous 3 months from applying. So what that means is for anybody that has regular dining out, takeaways, gambling, smoking, vaping, call it what you will, all of those things now will be included outside the bank's benchmarked expenses, which makes it really difficult in some cases for us to try and push back to the banks saying, right, well, what is actually discretionary, what is actually true expenditure outside of particularly the benchmark stuff. So what I mean by benchmark expenses is the banks will have a certain formula based on a family dynamics, so number of adult borrowers, number of dependent children and number of vehicles. That will drive a monthly expense ratio that they allow for after debt servicing costs. What we now find they're going in and all of those additional things over and above that I mentioned before, they are now including those as additional expenses. So where somebody may have a family dynamic expense of, for example, $1,200 a month, in some cases we're seeing borrowers where you can have up to an additional $700, $800, $900 of expenses the banks are including, which makes affordability really, really difficult to demonstrate. We're also finding that from a property investor's point of view, there's also been a number of changes there that have quite heavily impacted on investors. So historically, the banks have taken a rental approach of saying for every dollar of rental income that a property investor had, they would scale that back by 25%, meaning 75% was inputted in as an income ratio and there was no further deductions. Now what we're seeing is that that rental income needs to also have rates and insurance deducted, and in some cases now they're obviously adjusted the scaling, so they now pulled that back to 70% of rental income with rates, insurance and those other things deducted on top. So what that's meaning is that now the net scaling for an existing property that doesn't enjoy new build benefits, which I'll touch on a bit later, you're probably looking now at closer to 55 cents in the dollar being included for income, as opposed to where it was 75 cents. So we're finding that's been a big game changer around demonstrating affordability. It'll also for borrowers, on top of that, they will look at their personal side of things, and then their personal expenditure comes into it. So we are finding at times that it is difficult for clients to actually demonstrate they can meet the bank's lending rules. Also, if you use a property manager, they'll include those expenses over and above. So it seems at the moment that triple CFA with the discretionary spending has had a massive impact on the lending landscape. So you have two different types of, obviously, investment property. You have the existing property that is classified as non-exempt. So if it's 6 months or older, it doesn't enjoy deductibility anymore versus a brand new build that you can continue to deduct it. You can deduct interest for up to 20 years. And if you sell that property within that time, you can pass that on to the next purchaser. So what we're seeing is there probably has been a shift from property purchases towards those new builds for those reasons. Also, it helps ensure that you meet healthy home standards, and obviously there's the less maintenance side of things as well. So those new builds have become increasingly popular over the last couple of years. Now, there's been reasonable speculation through the media that if there is a change of government at next year's election, that the interest deductibility side of things will be reviewed and potentially repealed. That probably will be a good thing for anybody owning existing investment property, because at the moment that is in the underway of being phased out. It was going from 100% to 75 to 50 to 25, so we're partway through that removal now, and within a couple of years, even someone that owns an existing property now will have no ability to deduct beyond there. So as far as the traditional way investors get into the property market, they'll generally equity leverage, as Judd touched on before. And what we're finding at the moment is when investors tend to look at their numbers, it is tougher to make it work right now if you are not putting any money in, for the simple fact of obviously property prices still being quite high, but the big thing has been interest rates pushing up. So where if you went back a couple of years ago when interest rates were sitting at around the early 2% mark, it was a lot easier for 100% borrowing to actually cover the property costs. Probably not from a principal and interest basis, but more from interest rates and insurance, whereas now we're finding with those interest rates having pushed up into closer to 5% plus, it makes it quite difficult for those properties to actually fund themselves. And saying that though, as Judd said, if you purchase something over time, the value of that asset should grow, your return will get higher, and then we'll get that point where it will actually certainly cover itself moving forward. So we've certainly seen over the last couple of months probably more activity or more inquiry from investors again. They are certainly coming back into the market. Probably a lot of what I'm seeing personally is probably still a lot of inquiry around the new build stuff. Certainly when clients are doing their homework and doing their numbers, talking to likes of particularly accountants and things when they're going through what the tax position may be if you purchase an existing property and ability to deduct interest. I guess investors are still seeing it probably safer taking the approach of going down the new build at the moment. So with the triple CFA I mentioned before, we have seen some minor tweaking that the government's introduced around that. We've been fortunate enough for our CEO Brendan Smith, he's CEO of the New Zealand Financial Services Group, which is our parent owner. He's been on a select committee that's been involved in doing some reporting back into some discussion with David Clark. And he's very confident that before the end of this year, we're actually going to see some significant announcements improving the situation. Unfortunately, we're probably not likely to have those implemented until 2023, but we will at least potentially get a look at what they will be before the end of the year. And he's picking some of those changes will potentially be around discretionary spending, where there'll be more ability for us to perhaps explain some of those things away. Because again, when something is discretionary, the argument's always been saying a lot of those things, if somebody takes on additional debt, they can choose whether they still want to spend that money or not. That's the whole reason why it's discretionary. Also, that there's some rumour that there will be a change in the way that for investors, the scaling of income needs to be done. So we're hoping perhaps it may go back to more a flat amount and then not deduct anything further. Whether that ends up being a flat maybe 70%, perhaps not the 75 it was, I think any of those moves will certainly be a good step in the right direction. So the other thing that I just wanted to touch on also is perhaps from what we're finding around policy variations between banks. You know, there's not one size fits all. All banks do have slight variations in their policy from one to the other. So what we do find is that a lot of the time we aren't always saying, right, we'll meet the client, go through the full affordability and say, right, it doesn't meet at 2 of those banks, but it does at 2 or 3 here. And it's actually finding the best fit for the client. You know, particularly at the moment where some banks can be harder on those discretionary expenses than others. It's often trying to find out, say, right, where is the best fit for that client? And I guess one thing that, you know, a mortgage broker's job is meeting with the client, finding out what they're looking to do, and then saying, right, try and work out where the best fit and the best solution is. And from our side of it, I guess the big thing with a mortgage broker is we do the work for the client, we come back with the solution and options. The client doesn't pay for our service. It's part of what we do, it's part of our job. Probably one of the other things to touch on, just around, before Ben moves on and talks more about interest rates in general, you know, there's obviously quite a big concern for borrowers in either investment or personal space at the moment when it comes time to refixing of their mortgage. Obviously with interest rates, you know, even going back 8-9 months ago, we're touching in the low 2%. You know, there's been significant increases over that time. I think the official cash rate in October 2021 was lifted from 0.25 to 0.5%. Since then, there's been 6 increases, and it sits at a current level of 3% today. So it's a 2.75% increase in, you know, just over 8 months. Now, that's quite significant, and it's seen interest rates go from the low 2% mark to around the early 5s today. So existing borrowers, particularly those that fixed 12 months or beyond, you know, they're seeing their interest rate in a lot of cases, you know, just over double. So if you look at a $400,000 mortgage, say that was taken out over a 30-year term 12 months ago at 2.2%, if they were refixing today, they're probably looking at closer to 5.2%. And, you know, in some cases you're looking at maybe up to $160 more, you know, per week, which is quite a big jump. Now, I guess the big thing the Reserve Bank and a lot of economists have come out and said around that is that it's not going to mean that all of a sudden there's going to be a heap of people cutting their wrists or mortgagee sales exploding through the roof, because all the way through the whole process, the Reserve Bank has made the banks stress test borrowers. So whilst they may have been lending them money in the early 2% mark, they've generally been stress testing them at around 5.5% to 5.75% when they've actually gone to run the calculations for them. So most borrowers coming off those rates that around the early 2% mark will have actually had themselves tested at 5.5 to 5.7 when they applied. Interestingly enough, over the past few months, that stress test rate that most banks use is now sitting just under 8%. So they're constantly working ahead of the cycle, obviously not wanting to set borrowers up in a position where they simply can't meet mortgage repayments. So I think that's probably part of the reason why the Reserve Bank has been reasonably aggressive in their approach with interest rates to try and curb inflation, because they know the banks have actually been testing borrowers at a much higher rate in the background. We're also noticed that a number of borrowers that we dealt with, as they were coming off their fixed rates at a much higher level, they chose to maintain their repayments at the same, not changing them when they came off a higher rate. They've maintained that all the way down. Obviously that's given them a cushion as their interest rates push back up. They're already paying higher than they have to, meaning that, okay, they're not going to pay their debt off as quickly any longer, but at the same time it means they don't have to go and try and find that money again. So Ben's going to perhaps give you a bit of an insight now into what we see interest rates having done, and more importantly, probably for a lot of you, where we see them going in the future. So I'll hand you over to Ben. Thanks.
Good evening all. Yeah, as Gary touched on, I'm going to speak about interest rates, the OCR, and then just briefly on first home buyers and sort of how they try and get into the market. So as Gary mentioned, interest rates have almost doubled over the last 12 months. And an interesting stat is 40% of borrowers are about to come off rates, off fixed rates, in the 2%. So yeah, come the next couple of months before Christmas, they're going to have to refix with potentially a 5 or 6% interest rate. So no doubt those customers will be feeling the pinch, and that just sort of flows onto other areas. They won't go out for dinners and cutting back and coffees and whatnot. So it's just a bit of a flow-on effect, really. Overnight, ANZ, which is obviously the country's biggest bank, they increased their short-term rates by about 0.3%. So if you're an ANZ customer now, they don't offer any rates under 5%. So which is a huge rise. Floating rates, they've remained pretty stable. So floating rates nowadays sort of sitting around that sort of mid to late 6s. However, we're seeing the majority of people looking to fix their mortgages rather than obviously be on the floating rates. Tony Alexander, he's an independent economist. Some of you may have looked into some of his stuff or know who he is. He's predicting interest rates to start to come back and decrease in sort of late 2023. So yeah, there'll be a lot of people hoping he's correct, myself included. He also does a weekly a view called Tony's View, which is definitely worth subscribing, as he sort of touches on everything sort of property related. So yeah, definitely recommend looking into that. The majority of customers that we're working with at the moment, they're sort of looking in that sort of shorter term space with interest rates, predominantly sort of the 1 and 2 year fixed rates, as they do provide a good low in comparison to where they were, and they still provide a bit of security compared to other rates. I did read an article yesterday, and there was predictions of a 1 year rate of 6.3% for a 1 year rate in early 2023, which is a pretty scary thought, really. I'll move on to the official cash rate, because obviously that has a major effect obviously on interest rates, lending rules and requirements, and obviously the housing market. So the official cash rate is a wholesale rate which banks borrow money at, and then obviously the retail rates is what they lend it to the customers. As Gary touched on, the official cash rate is currently at 3%, which is a 7-year high, and it is widely expected to increase by another 0.5 in early October. ANZ, in the last couple of days, they've come out and predicted that the OCR is going to rise to 4.75, which is a huge increase. A few months ago, they were sort of predicting a rate of 4%, so you have 0.75 increase in that. And inflation's at a 32-year high of 7.3%, which is crazy to think when the target market is 2 to 3%. The last topic I'm going to touch on is first home buyers. So going back to Tony Alexander, who I touched on earlier, he does a weekly survey of real estate agents and mortgage advisors across the country, and the most recent results show an increase in people looking at buying an owner-occupied home in Dunedin. These results for Dunedin are a lot higher than other places around the country, which is certainly positive. And yeah, as we sort of mentioned before, as a business, we are certainly starting to see more inquiries, especially from first-home buyers and a few more investors getting back into the market. Obviously, the majority of you guys are all investors, but you may also need to think about investing in your children and sort of trying to help get them onto the property market. Obviously, due to the current lending rules and requirements, the majority of lenders are all sort of wanting that 20% deposit, which is a fair amount to try and stump up with, especially here in Dunedin. There are, however, client water loans, which offer loans to what as little as 5% if you meet their strict criteria. Probably about 80% of the loans that we're doing at the moment for first home buyers are with these client water loans, and that's just obviously due to people not being able to come up with a 20% deposit. I'll briefly touch on a few ways you guys can help your kids into properties. And if you want any more specific information, then you get in touch with Gary, Sally, or myself. Ways you can help include guaranteeing the deposit up to that 20% using your existing equity in your properties. So that way you're not actually having to come up with any savings or any cash to help. You're just solely using your equity in your property, which is a good way. Another option is obviously gifting them in lump sum, which can help contribute to their deposit. That can either be by topping up your mortgage if you don't have the savings yourself, or obviously your savings can do that as well. Co-borrowing with your with your children is another option. So you can be joint borrowers, and then once they've built up enough equity in the property, they can look to take over the mortgage themselves. And then lastly is across the country we're seeing the bank of mum and dad. So that's when the parents are actually purchasing the properties for the kids. They may look to rent out the property in the short term, and then when the children are able to take on the mortgage themselves and selling it to them, and they can take it over. That's all from me, but yeah, I'll pass it on to David, and he'll have a bit of a chat about the rental requirements.
Thanks, Ben. Thank you very much to Ben, Gary, and Sally. That was fantastic. Right, there'll be a Q&A at the end with the whole panel, so you'll get a chance to ask your questions then. Strap yourself in. David Faulkner, our General Manager of Property Management at Property Brokers in New Zealand. Thank you.
Strap yourself in. What do you mean by that? Got it, guys, and I'm just wondering what that buzzer is. Is that to get off the stage? Time's up, buzz, get off. Anyway, how are you doing? Thanks for coming out on a beautiful Dunedin evening. I'm based in Palmerston North. It's funny when I listened to Judd there before, when he's talking about 2001, 2002, the property prices going boom. That's when I came over. And the other thing to take into account, which you've got to remember, at the time it was $3.30 to the pound. And I came over and I'm just going, oh my God, I've got moolah. And I remember my wife on a bit of a spending spree, and it was fantastic. But anyway, there you go. Here we are, 2022, and it's the UK is not looking so good at the moment. And anyway, so Cots, how's your rosé, by the way? Do you need topping up? Or are you okay? Your rosé's good. Rosé's good. Okay, yeah. So just keep clicking away. So, oh no, you do want to top up. Come on. We'll get you a wine while you're doing that. You've been working very hard. We'll just get you topped up. Oh no, she's got another one coming. Right, so my role, I've been involved in property management since about 2005. I fell into it as a career. I never chose it, it chose me. I became a landlord by mistake. I used to work in hospitality, had a transfer, and ended up deciding I'm going to rent out this house and we'll go and buy in when we moved. And I did everything wrong. Tried to charge too much rent, got the wrong type of tenants. I ended up paying the tenants money to leave. And not to be deterred, once we'd done this, I gave, time's up, thank you, yeah. I gave the property to property brokers to manage. And from then on in, I never looked back, and 12 months later I went in to see property brokers about something else, and I walked out with a job as a property manager. And I did that for 2-3 years. Then I became manager at Palmerston North for property management. Then I became the national manager. Did that for 5 years. Then I went off for 7 years and did my started a training company for property managers called Real IQ, and then in January I've come back to property brokers. And and hopefully I can see out my career here. What I'm going to talk to you tonight is, if you just go through the other way please, Connie, is what I perceive will happen in the future of renting. I have studied this topic for a long time, and just to show you here what we do, we've partnered with this gentleman down the bottom here. He's actually from Manchester. This is Professor Graham Squires, and what we do a quarterly review, quarterly report on what is happening with rents, and we'll pick a particular topic. So our next course that we're doing is going to be North Island versus South Island, because there are some differences. We're also looking at the impact of government policy on particularly on social housing and the social housing wait list. I mean, remembering that this was the government that was going to fix housing and remove poverty. Well, that's not going particularly well at the moment. I'll say that this government, they've had good intentions, but I don't think that they've quite been on point on certain aspects, particularly around the interest deductibility. But anyway, so if we keep going, what I'm going to talk about first up, I'm going to give you some indication on what's happening with rents, where I think rents are going to go. Importantly, and this is something which is overlooked quite a bit, is what's happening with how many bonds there are. And that gives an indication on what's happening with market and landlords getting out. And we have seen a number of landlords vacate the market, particularly round about this time last year, October, November. We saw a lot of properties sell, not just from property brokers, but from industry-wide, because back then I wasn't with property brokers, and I was getting reports from a lot of property management companies and real estate companies that landlords were selling, cashing in on the capital gains. I think interest deductibility would have impacted that as well, but what it's led to, we've seen is quite a peak in rents and what's happened with rents. And what we've got here, this is the geometric mean rents. Everything I'm telling you today, the stats I get you is from the MBIE website. They've got some really good data on that site in terms of number of bonds and what's happening with rents. Right? And this will show you what has happened here in Dunedin. Now, what are these spikes? This is January, and that's your student market. So you've got two markets in Dunedin. You've got your student market, which will have much higher rents, obviously, because you've got like 4, 5, 6 bedrooms. Some of those properties with those fantastic names, very creative names. And then you've got what I will just call the normal residential market, which is a lot lower, but that's because the properties are typically smaller. So, interestingly, Porirua, of all places, and Tauranga, I think last month, but typically Porirua has the highest rents in New Zealand, which you think, why Porirua? Why wouldn't it be Central Wellington? But because Central Wellington is made up of a lot of 1, 2 bedroom properties, where Porirua will make up 3, 4 bedrooms. So it inflates the rents because of the size of the properties. The two lines that I've got here, these are trend lines, right? And if you're just looking at if it was a straight line, that's what the projection should be. But we've seen the curve accentuate and go up, particularly round about from 2017, 2018. Does that have anything to do with the change of government? It may have done. Things like healthy homes, the changes that we've seen in our industry. So first of all, removing the letting fee. Remember the letting fee? The tenant used to pay that. Now, you can't wipe out 15% of a property management company's income and just expect them to wear the cost. So typically the management fees go up, all that cost gets put onto the landlord. The landlords didn't really push back on that, but what happens is that they're going, okay, well, this is an extra cost, we'll increase the rent a little bit more than normal. Then you have healthy homes. Healthy homes, well-intentioned, not a bad thing. We need to see more dry homes in New Zealand. But again, it's an added cost. Then you get things such as interest deductibility, all types of things coming in, and this all impacts the cost that a landlord has to bear, and that cost is going to be passed on in whatever they can in terms of rents. It's not landlords being greedy, it's economics. It's running a business. If your costs go up, your operating cost goes up in running a business, your cost gets passed on to the consumer. We're seeing wages increase astronomically Now, at some point, if wages keep going up and up and up, businesses don't make money unless they increase they increase the prices. It's no difference at all. All right? Can you just next slide, please, Courtney? The clicker's not working, but the pointer is. Now, this is what I'm trying to show you here in the different markets. In the blue, you've got this is the student market versus the just typical residential market. Now, the gap has just got wider and wider ever slightly with the student properties against the residential properties. Now, I think I've got some little notes in front of me on this slide. Oh, here we go. Yeah, just click through these, please. So the student rental it's an average of 4.1, residential 4.4, and this is going back, and I think, I forgot, was it you, Judy, when the comments around the Real Estate Institute with statistics? Same thing with bond data. Since about 1993, we've measured bond data. So you've got all this historical, what actually happens. So it's pretty consistent, around about that 4-5% rental inflation since records began. The last 3 to 4 years, it's increased to around about 7-8%. And yeah, so you've got that. Just click again, please, Courtney. And you can see really now, since the last 2 years, you've seen the student residential rent of inflation has gone at 9% compared to residential at 6.8%. All of this impacts inflation nationwide, cost of living. And the next one, click again. Right. So yeah, on average, looking at throughout this, it's about 33% higher for student rents compared to your typical residential rents. So they're just indications of the two markets that you have in Dunedin. Next slide. Now, what's this graph? This is your bond information. This is your bond data. There are roughly 12,000 active bonds lodged in Dunedin. Right? So it gives you an indicator of how many bonds there are, or how many rental properties there are owned by residential investors. This doesn't take into account social housing, Kayanga order. This just looks at bonds lodged by your typical rental market, nothing to do with social housing. And you see these dips and these spikes. So what typically happens in December, there's a whole heap of bond refunds as the students leave. And so about a quarter of your market, I think, there you go, yeah, it's on there. So about a quarter of the market is students. And then in January, you get all these bonds being lodged again. And that's what you see. Interestingly, you're seeing this curve levelling out. So you've had a bit of a growth in student or in rental accommodation, full stop, but it's starting to flatline. Probably is time where we need more rental properties. And it's just a theory, but this is why I think we've gone from a social housing waitlist 5 years ago from about 5,000 on it to now it got up to 27,000. The last quarter it went down by 1,000, so they're starting to finally lower that. But I'm sure many of you would have seen that documentary on Sunday on the motels in which was, it infuriated me. But I have to say it didn't surprise me. And when I was doing the Real IQ days, we actually did a lot of training with these social housing providers, and I'm looking at them going, God, there's so many of them. So just interesting stuff. All right, next slide. What I've tried to do here is project where I think rents are going to go, looking at historic data. So just give us a click, please, there, Courtney, and this will get us to where we are. So the point here is that's where we are in time. All right. Now, what we've got here is the trend line if it's going straight, and what I've done here is the trend line if it's going in a curve. So the current growth since 1993 is at 4.6% per annum with rents. So I've actually done this and gone, what happens if it's at 4%? So let's just presume rents increase year on year at 4%. It won't always go like that. You'll see some of it may go up a bit more and then it'll come backwards. But that's just giving you an indication as to where things might go. So if you get to 2040, if we're alive and we're around to see it, you anticipate your rents for a standard property in Dunedin be anywhere between $850 and $750. So that's just continual growth on rents, where you see it when you look at historical data. Right, so that's where I've got done that research from. Next one. And this just shows you what's happened with median rents in New Zealand since we started records. And you can see here, that's where that spike has gone up in recent times. It's typically, again, between 4 or 5%, but in the last few years, it's been 7, 8, 9%. Right? It's been moving quite a bit. And I think a lot of it may have been with costs and a reducing supply of rental property in relation to demand. Next slide. This is interesting because I refer to what happened in Christchurch post-earthquake. And I think Christchurch, if you've got to do a blueprint of a city, you do it around Christchurch. Yeah, the rebuild has probably taken a little bit longer than the Cantabrians would have liked. But what they did post-earthquake is that, I think it was Jerry Brownlee who did it, made the councils release all this land at once. Right? And subsequently, Christchurch is probably, when you look at affordability and livability, it's the best city in New Zealand. Right? I know there's going to be a bit of biasness, and it's full of Crusaders fans, and I get it. But if you're going to move from overseas and going to move to New Zealand, people will look at Christchurch in terms of the quality of life and house prices and rents. Right? And what you can see, and this grey line here is Gisborne. Now, Gisborne was probably one of the cheapest places to rent in New Zealand. And look, and whereas Christchurch is the green line, Gisborne is now more expensive than Christchurch. You just wouldn't believe it. Yeah. But and I'll show you why that's happened in a moment. Next slide. So, yeah, we'll keep going. I'm talking about Christchurch. Christchurch is probably the most affordable city in terms of New Zealand. Now, if you just give us a couple of clicks. And again. So, what I'm highlighting here, here's your earthquake, round about here. And then you see the big spike, which goes much higher than the normal curve, because you've got a lot of buildings destroyed, and it creates this supply-demand scenario. And you see prices go up because there's a shortage of stock. But here is when the rebuild really takes effect. And prices actually came down and levelled out. And the rest of New Zealand caught up at Christchurch and overtook Christchurch. So the moral of all of this is, if you release enough land, now I'm not going to get into how we do this or whatever, but if you release enough land, we get enough development going on, and we get enough stock, and we get enough supply, you control rents and you control house prices. I've got teenage kids, and I've got a daughter who's 19 who's got to bugger off to Manchester, and part of it is because we're in Wellington at the moment, and part of it is it's cheaper, and so you can go overseas. So I do think we will see a bit of a brain drain. Though in saying that, if it all turns to custody in Europe, which it could easily do, we may see people come back the other way with immigration. So who knows what will happen there. But that's a good little indication of what happens when you get it right. Next slide, please. Here, this looks at the number of bonds. So net gain in bonds. How I calculate this, and this is off MBIE data, I'm looking at the amount of bonds which have been lodged versus the amount of bonds which have been closed. So if there's a negative, it means that there's a reduction in active bonds. You can see the impact here of the earthquake. Interestingly, what you can see here in 2021 is actually quite common in a number of our centres. So keep going. And we've seen a big drop in 2021 in the net gain of bonds. It's the biggest drop on record. And when you look at the last quarter of last year, you've seen a lot of our suburbs and a lot of our towns, we've got a negative gain in bonds, which again puts pressure on the rental market, which leads to rents going up. Keep going. Yeah, that's the slowing down, and you can keep going with this, Courtney. Sorry, probably overkilled it with the graphs a little bit too much. This is the percentage growth in bonds since records began. And you see here, it's the lowest. We've virtually had no growth in rental properties in 2022, where we're seeing more and more, we need more and more rental properties. So, dare I say, has government policy actually worked, or has it backfired? They may have gone, these landlords are all greedy, blah, 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 we're going to show them. Well, what landlords actually provide is a valuable service that this country needs. The state is not going to be able to house everybody. And you know, I was at the New Zealand Property Investors Conference 2 weeks ago with Palmy, and Tony Alexander spoke. Very entertaining, Tony Alexander. And he basically says that New Zealand, 4% of the property in New Zealand is social housing. When you look at the OECD, the average is 8%. So the state, you know, they're not going to be able to house them all. They need your service, and you add value to New Zealand. Okay, next slide. And this is the impact. Okay, so this is Wellington. Wellington, for the first time since records began, lost rental property, so 348 left. Right? And the next slide shows you why Gisborne has overtaken Christchurch. So that's 5 years in Gisborne of capital gains and issues. It may be hard, you know, it's quite a low social economic market there. And it all relates to what's happened. So the next slide can show you what's happened with provinces versus the cities. So Gisborne here, at 2019, December 2019 at 350, it's gone up by $123 compared to Auckland, which Auckland probably did best out of COVID in terms of rents, because you know you had that big market of international students and whatever, and everyone left, and so there's a lot of apartments sat empty around Auckland, and rents barely changed over that 2-year period. But you know, it's not just Gisborne, the Horowhenua, Palmerston North, where you're seeing more than double-digit growth. I mean, Horowhenua, it's 20% year-on-year growth in rents. In Levin, what's so good about Levin? I don't know, but there you go. Next slide. So that's giving you an indication on the influences of rents, bonds, and you know, the talk is really about what to expect in the future. Giving you an indication of rents. These are some of the theories that I have, which landlords just need to be aware of, and investors need to be aware of. And I am a landlord myself, residential. I've also got a commercial coming as well. And these are some of the things that I think have big influence. And the main one really at the moment is legislation, and the one which I really want to touch on is net carbon zero. Now, I'm not going to get into debates on the merits of climate change, but one thing I will tell you is that this government, as well as National have supported us as well, I think the only people who have opposed this act, is committed to a net carbon zero by 2050. Right? Net carbon zero by 2050. Have you ever thought of what the environmental or the carbon footprint of your standard 5-bedroom student property in Dunedin is? And to try and keep that warm. And across New Zealand, I think that, you know, I don't know what the environmental footprint of rental property is. But it's a guess. I don't think it's probably that good. I certainly don't think we're net carbon zero. So I expect to see a number of changes come into effect which are going to impact landlords around greenhouse policy and greenhouse gas policy and having a green environment. And it's going to impact this country, it's going to impact everybody in so many different ways. I mean, you think about the amounts of electrical. I mean, I've got a 17-year-old son who's finishing college this year, and we listened to this interview by a guy who's an electrical engineer, and his theory was we need to triple the amount of electrical engineers to cope with the demand, because we've got to triple the electricity grid to cope with the demand. I don't know how we're going to generate all this electricity, you know? So it's really, really going to impact, right? Rent controls, God forbid that ever happens. I don't think it will, but you never know, you never know. And other things to take into account, so renovations, retrofittings will link very closely into this, right? One of the things which hasn't been touched on, and we did a webinar for property brokers on Monday night, is this, green loans, right? So you can go to some banks now and get these very low, you know, some 0% or 1% loans to make sure that, you know, I'm going to get double glazing. I honestly feel that we're on a path towards, you know, double glazing becoming compulsory within the next 10 years. And you know, it could be worth, there's the buzzer, it could be worth looking at doing things like that now before, and this is what we saw with Healthy Homes, is just everyone put it off to the last minute, mad rush, prices of heat pumps go up and all sorts, and there's a real scramble. So be ahead of the curve and start thinking about this now, because you know the price of double glazing will go up. Next slide. Keep going. And these are some of the headlines. I like to look at the UK, not just because I'm from there, mainly because, you know, our law has taken from the UK. And so there's a lot of similar trends to seeing what we see here. I mean, the latest one which has come out, why it could be curtains for sash windows in the latest net zero plan. So if you've got sash windows, they're getting banned in the UK. There's talk on policy around that. The risk of all of this is that we may end up having ghost houses where landlords or people just go, I'm just going to land bank, I'm not going to rent it out, because the cost of implementing all of this is way too much. So these are some of the things that you may see in the future. All right? And to finish with, final slide here. Now this is called energy performance certification. This is standard in UK and European houses. I anticipate seeing something very, very similar here. So just keep clicking through there, Connie. At the moment, you can't rent out a house if it's at an F or lower, but they're changing policy to make it to a C. So I am not going to be surprised, and actually I'm not opposed to this. The Greens and Chloe Swarbrick has been big on this, but I actually see merit in having a rental warrant of fitness or something similar, some energy performance certification. It's all very well doing healthy homes, but how long is healthy homes valid for? I can see a stage where it may be 5 or 10 years, someone's going around to assess, look at the performance of the property, and then it gets a grading. And we may have it where if it gets below a certain grade, you're unable to rent it out. All right, keep going. Green loans to retrofit that we've talked about again. Changes on taxation on rental properties. I think that's been talked about, but I do know I've actually got a meeting with Chris Bishop, and who's a shadow housing, and he did say that National will change that interest deductibility if they get in. And other things that I think that we're going to see more and more of, we don't see it enough really, is technology to measure the performance and looking at how much it costs to run a property. Tenants are going to become more and more acutely aware of that, and I can see it becoming standard where if a rent advert's out there, it's looking at this is the estimated cost it's going to be to run this property, and tenants will take that into account when they are making those decisions. So that's it from me. Just a little bit of a sales pitch for property brokers. I've got to take an opportunity while we're up here. So yeah, we are the third, I believe we're the third biggest landlord in New Zealand behind Kaingaroa. There's Barfoot and Thompson, which have about 18,000, but we've got 6.5. I think I added the value, estimated value. I think we manage about $4.5 billion of real estate across the country. And we're a training academy. You know, so I've run my own training company. Well, come back, and what we want to do is commit to making sure that all our property managers are qualified, that they've all got the level 4, which is the only NZQA recognised qualification for property management. We believe the industry should be regulated, and and once that happens, that's better, because it gives more protection to the consumers. We run our business as if it is regulated, so when regulation does come, there'll be no increase in costs or increase in fees or whatever for landlords. We run it as if the industry is regulated. We're very, very proud of that. So, you know, we've got a fantastic team in Dunedin and in Mosgiel, so if you want to catch a beer and have a spate, as I will be later on, then please do. So, thanks a lot, guys. Thanks for coming along this evening, and cheers.
Thank you very much, David. Much appreciated. One question that I have is, can anybody stand up here tonight and say that their own personal home is Healthy Homes approved compared to your rental properties? So you can all say that you've got heating, ventilation, insulation, drainage and underfloor vapour barriers at your house? Everybody? Colin? You can? Well, that's actually a big bonus. Compared to your rental properties, there's a lot of places that we as owners own our own homes, compared to our rental properties, are not up to the same standards that our rental properties are. It's really, really interesting. So thank you very much tonight, David. We really appreciate it. Judd? Gary, Sally and Ben, thank you very much for this evening. We're now going to have a, I suppose, Q&A session. If anybody has got any questions for any of this team, if they can come up here and we'd like to fire away. Oh, actually that will probably be
You take the over mic and we got the other mic here.
Oh, you're still broken down, Sally.
It's you, Ben.
Get up there, Sam.
You've got prizes in it, guys, come on.
Do you want to fill your classes first and then do a Q&A? Or you got a question at the back?
Just a minute.
Folks, you can pass me a rosé, please.
My question was kind of directed at Ben a little bit, something he said, and he was talking about something for parents to do for their children was to buy a house, rent it, and then let them buy it down the track. My question is, would the capital gains tax go against you when you're selling it to them, or does it change with what happens if you're selling it to family?
It would obviously depend on the price. So we.
Have you got that? You can't hear that very well, sorry.
Sorry, is that better?
Can everybody hear?
Yeah, I think if you hold it closer.
So it would depend on the price that you actually sold it to your kids at. So we are seeing a few people sort of buying properties and then selling it for the same price that they bought it at to avoid having to pay any capital gains for the bright line. But yeah, that's a question probably for your accountant and obviously your lawyers and whatnot around those sort of rules and regulations.
Thank you very much, Dion. Have you answered your... Yep, Pembroke. Yes? Yes?
Okay, so it raises two questions with me. The first one is, it's an article that I read that if the parent goes in with his kid, let's say 50%, and the kid has saved enough money or whatever to carry the other 50, the parents 50% over to his name, within the bright line time frame, then the parent is liable for tax. I don't know if you've got a comment on that. And also, I've forgotten the other one. Yeah.
I think they're more for the council, so
They could be liable for that depending on what the price was at the time. So when you purchased it versus what the perceived market value was at the time. So for the parents 50%, it would depend, and again it would be probably an accountant that would need to actually say where you stood there. Because if you, for example, bought the property at $500,000 at the time, and 4 years later the perceived market value was $600,000, yes, on that parent share, the IRD could potentially question and say, well, you could manipulate that price to sell your share to your children at the same price you paid, but an accountant or solicitor may advise saying, no, hang on, that's not actually market value. The IRD could question that transaction. So that is certainly something that would need to be considered. Depending on the length of time, if it was a new build when you purchased it, your bright line's 5 years. If it's an existing property, it's 10 years. So that's certainly something that if you're going into it with the view to having children involved later, you would certainly want to make sure that you did your homework first.
Okay, so to me that partially defies the object of actually fully helping, because you're carrying it over or buying the house to help your child, and then after whatever circumstances might change, and you actually end up having to pay for it, even if it's just carried over in his own name.
Yes, you could, definitely.
Yes.
And that's certainly something that, if we're fielding inquiry, that would always say, hey, make sure that you are getting your solicitor and particularly or accountant, involved at the outset, so you know what you may or may not be in for in the future.
Yeah, and the other thing I also thought of was you buy a house at the, say, $500,000 price. The value of it has gone up to, say, $800,000. You're actually being penalised for that capital gain.
Yes, it would be driven off at cost price versus sale price. So you're right, it's the $300,000 profit that's been made there. That's what the tax will be calculated on, and that would be at your particular tax bracket.
Thank you. Anybody else have any questions?
Any advantages like family trust?
Yes, there could be, although that would probably really only be along the lines of particular tax bracket. So if somebody was at the very top personal tax bracket and it was done through a trust, that could lower the tax position to the trust tax rate. but it wouldn't give you any advantage around capital gains tax, because every property transaction now, the buyer, whether it be a company, partnership, trust, has to have an IID number, and that IID number tracks it to the property and the ownership. So when it's sold, that's how the IID now can track you for right line tax.
Karen?
I have two questions about banks. Are they ageist when it comes to lending, or was it just totally on your assets and your income?
They can't discriminate under the Human Rights Act now. They can't discriminate on the basis of someone's age, because of course there isn't a set retirement age anymore, but they can still, I guess, hide around that in other ways. But in theory, we could still have somebody come in at the age of, say, 50, and they could still obtain a 30-year loan term, even though that takes them to the age of 80. Under the Responsible Lending Act and Triple CFA, the bank could still argue the other way, saying, well, there is no guarantee whether that person will or won't retire at the age of 65. So as long as someone demonstrates affordability, the bank will say the onus goes back on the client to make sure that they have an income stream that can continue to service that loan as long as they've got it.
Okay, and the other question is, do banks share information when you're applying for a loan, i.e. you're talking about how they go through your accounts to see what the spending is. A lot of people run two banks. Do they, you could be, I'm not a gambler, but you could be running your gambling account in one bank and applying for the loan in another, or whatever.
Yeah, well, I guess the only way the bank could in theory track that is if you were applying to your bank ANZ, they can obviously, even though we are forced with an application to supply statements for ANZ, even though it's going back to your bank, if you had another bank account with Kiwi Bank and the ANZ could see that there was a credit going out somewhere that we didn't provide statements for, they would ask where it's going to and would want statements. But yeah, if you were drawing cash out and putting it into another account and using it that way, yes, they wouldn't have any knowledge of that. So that would be, I guess, one way if you wanted to hide it, you could.
That'd be breaching privacy, wouldn't it, if they were talking
Yeah,
to
the
each other?
banks can't talk to each other,
can't,
but if the
breaching privacy.
ANZ can see that there's a credit going out to somewhere that there isn't a statement for it, they'll say, where's that money going? We want to see it.
Okay.
Thank you, Karen. Anybody else have any questions? Come on, don't be shy.
You were talking about the banks, and if you've been with one bank for a very long time, since you're like 18 or whatever, but been with BNZ, but you want to go to another bank, and you've been a good client with that bank, and you go to another bank for a loan, you're actually starting all again then, aren't you? Because you can't, that bank can't go back to BNZ and see that you're a good client for 30 years, so you better stay with the same bank.
Not necessarily, because to be fair, banks don't, a new bank won't tend to be concerned in anything other than checking your statements over the last 3 months now for your discretionary spending, and they'll really look at it then, what's your deposit or equity position, what's your income position. As long as you meet their criteria, they want to lend money. So they don't penalise you for the fact you don't have any history with them. In some cases, we've actually seen evidence where we've taken a client back to the incumbent bank and something had happened 5 years ago in the history, that red flags something at the bank's end, whereas when you went to a completely new bank, they were only tracking you for 3 months worth of statements, so it flew through with the new bank, whereas the old bank said, we don't like that whoopsie 5 years ago, we're going to hold that against you. So it can work both ways.
Gary, I've got a question. If you do, am I allowed to ask a question?
That buzzes in.
Yeah. No. Is the benefits of being... That's all right.
Oh, yeah.
That's all right. So, I've got a good friend who's got a mortgage brokerage business up in Auckland. He talks about the one bank trap. Is the benefits to using more than one bank in terms of investments?
Yeah, definitely. Definitely, because I guess with that, if you've got all your equity locked with one bank, so again, just BNZ, you had your own home and 4 properties, the BNZ decided that they no longer liked you or wanted to lend to you, you're very limited as to your options because BNZ's got everything. Then you can turn around and say, right, if I want to try and take one property away and go and start somewhere else, it can be very difficult to unpick that. The bank's got to agree to release it. And more importantly, if you're locked into lower fixed rates, you've got to break those, you've got the extra legal costs. So part of what I guess we would look at for someone, if their strategy is to look to acquire a number of properties over the years, there would come that point where we'd say maybe to a client you want to consider splitting your lending.
Yeah.
And to be honest, a lot of accountants now, for clients, they are giving that advice out too, saying consider dealing with more than one lender.
Yeah. Okay.
Do we have anybody else? Any questions?
I've got a question for the audience.
Absolutely.
Yeah.
Go for it.
Can we have a show of hands on pets in rentals? Who thinks tenants should be allowed to have pets in rentals? Show your hands. Could you please show your hands?
No, go show your hands.
1, 2, 3, yeah.
Depends on the pet.
Just interested. I'm always interested to gauge that, you know. Yeah.
So what are you saying, depending on the pet, is it actually the person and the pet, or is it just the pet itself? Yep. Yep.
The reason why I ask is, and I talk about UK law, is the UK is debating that its tenants are allowed to have pets, and landlords can decline so long as they've got a valid reason to decline. But, and I think this is a great idea, but the landlord can insist that the tenants have insurance that covers for any damage caused by the pet. Now, I think that's an excellent compromise.
I think that's, yeah, I think
And that's something I'm fully in support of if it was, put forward over here.
I have a,
Just in terms of, I guess, the exponential capital growth we've seen in the last several years, and then all the, I guess, macroeconomic and political factors at play at the moment, what do the next 10 years look like? I know crystal ball stuff. What do the next 10 years look like in terms of capital growth for their lack of?
That's a great question.
he was asleep, sorry, can you please repeat?
No, I did get it. What does the next 10 years in capital growth really look like?
Well, or their lack of. I mean, it's hard to foresee any sort of doubling of property prices over the next 14 years.
Yeah, look, it's interesting because we've had like periods of like 5 and 7 years where it's been quite level, and then it's taken off again. And like that immigration thing, there's always seemingly something that comes along that increases it. It's quite fascinating. And like as David was saying, like there's some serious issues in the northern hemisphere at the moment. So are a lot of those people going to come here? And there's not going to need to be too many of them that come here to make a huge impact. I think the interesting thing going forward is the affordability of groceries, the affordability of fuel, and the inability to pay rents. I think that's going to be really interesting. And like when you look at the real estate clock there at like 4 and 5, we haven't got to 6 yet. And clearly the residential bank, the Reserve Bank, doesn't think we have either. But you know, there's a bit of contraction going on, absolutely. You know, and as Ben said, you know, there's going to be some tightening between now and Christmas when those youngsters get those interest rates coming in, and what they're going to have to increase per week. It's going to be pretty interesting. So you get to a point, don't you, where the tenants can't pay anymore.
Yeah.
And it levels out.
Yeah.
And you know, this is the thing, inflation doesn't go on forever, because it gets to a point where the dollars stop chasing the product. So it's got a finite end, but we just don't know where that is. And like I think as an investor, like if you buy properties on the way down, then your average property price that you're paying is an advantage when you start to go up. But as I said, you've got to be pretty brave. But yeah,
patient.
Yeah, I know, but like, you know, if you look back at the world financial crisis, like it looked like the world was going to end. And who would have foreseen this? It's quite fascinating. And like, around the world, there's a feeling that the situation could get quite dire and they might start printing money again. We stopped printing some money apparently sometime last year, but that would be the easy fix. It would be the wrong fix because there's a whole lot of money that has to come out of the system. But that sort of thing could happen. There's so many levers being pulled at the moment. It's crazy. It's very hard to work out what really will happen, but it's all about money in people's pockets, and there's a whole lot less of it.
Yeah.
Isn't there?
Supply and demand.
Supply and demand. Yeah. I mean, what the government's done with its deductibility and the bright line. I mean, like I'm sure you'd agree it's totally unsustainable. like the government that gets in next time has got to change that, or else we're going to have people on the streets.
Yeah.
Well, we already do.
Yeah, yeah. Like it's incredible that they've done that. It defies logic. So it's going to be very interesting to see what happens, because that's going to be a real football come the election. Yeah. But love to answer your question better.
Good question, thank you. That's all going.
Someone want to
Okay, thank you, very good question. Does anybody else have any other questions?
I've got one more. The stats you have for the Dunedin City up there, they don't include Mosgiel or Waitaki or anything like that, they just be straight Dunedin.
No, it does. It includes the greater Dunedin area.
Oh, okay.
Yeah, yeah. And this was something I was going to say, like the real estate stats are unreal. There's so many figures there. If any of you ever want like stats that compare one suburb with another or all these things, we can get anything for you. So if you want to do some research, like do Sing Out. It's quite an incredible portal what you can pull out of there, if you're into stats.
It helps. I think it actually helps with people's queries really about where to purchase or what's the best purchase for their money and so forth.
Yeah. Good. What question?
Dion?
Just looking at the growth across the cities across New Zealand, which is getting nice and low, plateau. I've got one investment property now, and I would like in the next 10 years to grow that to 3 or 4. Would Christchurch be a good place to be looking to invest in as opposed to the other place? Because if it's got a nicer place, nicer houses, new builds, and their market's a little bit flatter at the moment compared to most of the other cities, would Christchurch be somewhere I could be looking in the next 5 years?
I'm going to give the mic to David, but like we've lost a lot of people from Dunedin to Christchurch just for that reason, because it's been affordable and it's new and it's a lovely looking city.
I think anywhere where there's a transient population, where you've got lots of movement, universities are good places, are safe places, are solid places. Yeah, I would say Christchurch. I would actually say Palmerston North as well with Massey, Hamilton with Waikato, Dunedin with Otago. So, you know, that would be my answer, but I mean, I can't give financial advice, but that's what, you know, those places where you've got a transient population, where you've got a diverse economy, I think is always a strong, safe bet.
I actually have a question. I spoke to one of our agents throughout the week, Carol, and she was explaining to me that brand new build versus an older home. And Carol explained to me, I'm not sure if any of you are aware of, is that a brand new build nowadays is considered 20 years. Is that correct, Carol?
Yeah, Gary.
You care at that?
March 2020.
Yeah.
Still a new build for 20 years.
And has everybody heard that and understands what that all means?
That's the interest deductibility you're talking about?
Yeah.
Yeah, so it just means that property can be traded and sold, and within 20 years you've got that deductibility going on. So I mean, I think a lot of us thought that if it was sold, it wasn't a new property anymore, it was a second-hand property. But it's new for 20 years. Now I imagine that is from, someone might be able to tell me, I imagine that's from issue of code compliance certificate?
Yes, it is.
Yeah, yeah.
But you may have a change of government. Who changes it all?
Yes. Yeah, very true. Yeah.
So what's your new build per square metre?
Oh, what, to build it?
Yeah, these days, because like 14 years ago it might have been like 1,200, 1,500 dollars.
Yeah, well, we've had this debate just recently, and like it certainly seems to be 4,000, and it's approaching 5. Yeah.
So you take the build.
Yeah, absolutely. And like sections as a result have been pretty slow to sell. There's been some that have sold, but they've had to be priced really well, and they've had to be in good locations, preferably on the flat where the build cost is lower. But yeah, there's been probably a lot of people who have resold their sections thinking, I can't afford this, or probably the bank, no doubt, has knocked on their door saying, how are you going to afford this? So, yep, we could do with some method of cheaper housing, but like as David said, like Christchurch is fascinating because it released a whole lot of land, and that was the blueprint the whole country should have followed.
And their bills seem to be cheaper somehow.
Yeah.
Somehow.
Yeah, they do.
Are they still cheaper nowadays though? Is that?
You can only do that though when you've got a geographical kind of land to release.
Yeah.
We don't have it in New Zealand.
No, Dunedin was no.
What I will say there is that, I mean, we've got a population of 5 million. UK's got a population of 65 million. Japan's got a population of 120 million. They're all relatively the same size. I just don't understand how New Zealand is a shortage of land.
Yeah. And I mean, that last district plan, like if you look at Mosgiel, it should have gone straight back to Paruali, and it didn't. And so there's definitely mechanisms within councils to have infilling going on, for sure.
Yeah.
Like if you drive around Dunedin, tons of land, and like right up through Abbotsford, back of Abbotsford, fabulous country. So yeah, they could release a lot more land. Yeah.
Good night, everyone. You get a lot from it? Yeah? Yeah.
Any more
So
questions?
it's been recorded, so we will make that available, and if you want copies of the slides, are you alright with your slides, please? Yeah? I'm fine, and we'll make those available for you. Yeah, so thank you.
Thank you very much, team. I'd like to hand it over to Wayne.
We're just going to do our spot prizes, and then we'll hand over to Foxy just to finish off. So, Dave, can I get you?
Thank you very much, guys. Much appreciated.
Orange B 25.
Yeah, see. Oh no, it's bingo, isn't it?
Orange B 25, here we go. Is your winner?
Thank you. Thank you very much.
B014. 14. There you go. Yes, no. 28. 2 and 8, 28. Yep, there you go. I think it's good enough. It's close enough. It's close enough.
You're a winner tonight.
No, it's not wrong. It's wrong. Joking off, you're joking.
Colin, you can actually pick
Hey, Price. All right.
Number
Number 8.
What have we got?
Number 8. Don't screw them up. Oh, do you? Okay, sorry. Number 20. Oh, 20? Jeez. Did anybody pick any tickets? 21? No? Keep going. Yep, we've got 21. Woo. 3030. Yes, we got a winner back there. 2 and 6, 26. Yep, come on, big prize. Two and 3, 23. I used to call bingo, you know. 3 and 6, 36. Outstanding. You got the best question of the night tonight, so well done. Keep that, frame it, it's going to be worth millions. 2 and 4, 24. How many prizes we got left?
Shitloads.
Are you right?
On its own, number 1.
You lost your number.
You need one of these in your helicopter? Are you gonna hold
3 and
on?
5, 35.
Hold on to that.
Hold on to that.
Yeah.
All the 2s, 22. I'm not throwing the bottle here, we can put health and safety. 3 and 4, 34. Yep.
Oh, look at that.
Give him the bottle.
Thank you.
Put your gin in
And
there.
who wants a cap? We'll just throw a cap out there and a cap out that way.
Look at that.
Lovely. Thank you. Good. Oh, we've got a major draw prize. So, Andy? Annie? I thought it said Andy. Sorry.
So Annie's from Blue Skin Electrical, and she's kindly donated the major door prize, which is
8 hours of transfer electrical labour.
Well done.
So get Annie to draw this one. $29. Congratulations, well done.
It's fine, we'll trust you. Thank you. All right.
Thanks, Wayne. Good evening, everybody. I get the pleasure of thanking you very much for coming along this evening to listen to the loan market. And I must admit, recently I had my eldest and helped him get into his first house. And I've been banking for 10 years, luckily. So I would suggest, if you ever have that sort of thing, using the loan market with Ben, Gary and Sally would be an absolute must to make sure that it is done properly, because there was a lot of fish hooks, believe me. And today what they know in the market is really important to getting you a good loan with good criteria and terms and conditions around it. So from that side, and from property brokers, if we do manage your property here, thank you very much. If you are interested, don't hesitate to give us a call. And any other things, the likes of our residential rural side as well, more than happy to help. So great to see you along tonight, and thank you very much for Judd, the top real estate agent apparently in Dunedin, for giving his speech, and David coming all the way down from Palmerston North. And if you ever want to call David and ask him something, he's got a lot of experience, he's been right through the country with property management, don't hesitate to give him a call. And to all the guys that are here tonight supporting, thank you very much for property brokers as well. Have a good evening, and look after yourselves out there. Cheers.
It was an absolute nightmare trying to lend money for the kids to
I can well imagine.
That was really good,
I was going to say one last thing.